we have George Lane here with Guild Mortgage. Hi, George.
Hi, Mello. How are you doing?
Pretty good. Thank you for, giving me some time and we could chat about the different changes in the mortgage world right now for any prospective home buyers. And my first question would be, is there a change home buyers always ask me, what is the minimum credit score they have to have in order to be qualified to buy a house?
Right. That's a great question. Okay, so we'll unpack this in a couple of different ways.
Okay.
When we're talking conventional loans, typically we need, well, not typically, you need at least a 620 credit score. And there's a little bit of a step back from that. When we say a 620 credit score, what we look at is we pull a credit report from all three credit bureaus, Equifax, TransUnion, and Experian. And when we say someone's credit score is 620, it is the numeric middle of those three. That's what we look at, okay? So what can happen a lot with clients is they'll look at Credit Karma or their Experian score or whatever, just a one, and those, when they're seeing those scores, those are not the same credit score models that we use from Fair Isaac, specifically for mortgages or auto loans, those sorts of things. So a lot of times Credit Karma can look higher than what their actual score is because it's not pulling all the data in. So that's just something to be aware of, that to know really what their score is, they either want to go to the site where it's called annualcreditreport.com, which is all three bureaus, and they could go there and pull their own scores and see it for themselves. But really what they want to do is talk to a lender and find out, okay, specifically what am I looking at? Okay?
Yeah.
So for conventional at 620, with FHA for Guild Mortgage right now, our minimum score is 600. Before the whole COVID-19 craziness, it was 580. So we raised our scores a little bit as part of this process. Now, what I would tell someone right now is realistically for an FHA loan, you need to be at a 620 credit score. And the reason for that is we have pricing overlays right now below 620 that are prohibitive.
Okay.
Cost a lot of money to get that rate. And for most people, as first-time home buyers, it doesn't make sense. So what I mean by that, it costs a lot of money. There's a discount fee. So below 620 down to 600, it's 3%. So if you had a $300,000 loan amount, that's $9,000 at interest rate. So that's not very attractive. From 620, there's still a little bit of a fee, but we actually just lowered it today. It's quite a bit more attractive. And then 640 and above, no fee for the score, so you're all good.
Okay.
There are a number of lenders right now that aren't even going below 660. So there's a lot of variance out there amongst lenders in terms of what those scores are. But so FHA, for all practical purposes right now, you really want to be at 620 or higher.
Okay, so FHA and conventional, you're safe at 620.
Right.
Okay.
And with VA, you can go down to 600. On VA, there's a little bit of a cost for that below 620 score, but nothing to where someone would say, oh, I'm not going to do this. There's just a little extra cost for that below 620.
Okay.
So those are kind of the general rules. Now let's talk a little more broader perspective. From a practicality standpoint, if we're looking at someone who is below a 680 credit score, we're probably going to be looking at FHA. That's probably more sense for them to go FHA than conventional. And the reason for that is the pricing for conventional loans below 680 gets pretty severe. That discount fee that I talked about at the below 620 score for FHA, well, it's going to be a lot steeper on conventional below 680. So typically your FHA is just going to make a lot more sense from an interest rate standpoint. But the other factor that we have is mortgage insurance. And if you've got below a 680 score in conventional, the mortgage insurance cost is going to be typically quite a bit higher than it is on FHA.
Okay.
A lot of times I've got clients, if they're not putting 20% down and they're below 680, FHA just makes more sense. The payment is so much lower than it is on conventional. So when we get above 680, that's where it gets to be kind of even and then above 720, conventional almost always makes more sense than FHA does. So it's there's practicality in terms of what you can do one way or the other, but there's pricing that really comes into play, the difference between conventional and FHA.
Okay. And what you are saying too is it's more practical for them in the long run during their monthly mortgage payments.
Right.
Throughout the course of the loan. Okay. So 720 conventional, below 680, it's more practical to do FHA. Okay.
680 to 720 band, it can be a toss-up sometimes. So we're looking at it and just kind of saying, hey, here's FHA, here's conventional. You know, what are you going to be more comfortable with? And there's a lot of other factors I could get into that would be really boring right now. But when you get that 680, 720, there's times where conventional might be a little bit higher payment, but in the long run might be a better deal than FHA for reasons about getting rid of that mortgage insurance kind of on a longer term basis. So that's a conversation that needs to be had face to face and kind of walking through it.
Yeah.
So and then one other thing with credit score I was going to say is on down payment assistance programs. So typically the down payment assistance program, Home Advantage is the most common one that we use. Mm-hmm. 20 or higher credit score is what we needed. Right now with an FHA loan, if the debt to income ratio is above 45%, we need a 660 credit score. Okay. If it's below 45%, then we can go down to that 620 credit score. Okay. So debt to income ratio, what we're looking at there is we're taking the housing expense that we're creating with this new mortgage. So principal and interest, property taxes on a monthly basis, and homeowners insurance on a monthly basis, and mortgage insurance, all that tied together. And then plus auto loans, credit cards, student loans, alimony, child support, anything else that they might have. So all those number, that payment on a monthly basis divided by their gross monthly income. Okay. Yeah. So if that number that is above 45%, we have to have a 660 credit score. If it's below 45%, then we're down to 620. Okay.
I'd like to branch off to that when you mentioned the down payment assistance. Mm-hmm. So that's a good point that a lot of home buyers are not aware of how they can obtain that. So what do they have to take classes for it, and what are their requirements? Yeah,
good question. So there is a class required. You can take it in person, although anymore most everyone does it online. The in-person class, you either take it, one 5-hour, 6-hour chunk. A lot of people do it on a Saturday, but I've also seen some people break it up and do it like on a Tuesday and Wednesday in the evening. But anymore, you can do it online. That's so easy because then you can take it over 3 nights. You can really break it up more easily. I will say this: I've taken the class myself because I wanted to know what I used to teach the live one, but I've taken the online class. It's actually pretty good.
Is it?
It's a little long, but there's some good information in there. Most everyone walks away from it saying, "Okay, that was okay. That was worth my time." So you've got to take that class, and you can take that class at really any point, either before you even start home shopping, but you can also be in contract and take the class. So there's not a requirement for when you get that done.
Okay, and you get a certificate after that class?
Yeah, you get a certificate, and just online, you just print it out or save it as a PDF, and just we have to have that certificate before we can lock in their interest rate.
Okay.
Most of the time with our clients, we're saying, hey, if you can do this in the next week, that'd be great. Perfectly to be able to lock your loan when we're ready. Okay. So that's a good way to go. For the down payment assistance program, the only other real for the Home Advantage program, the only other real restriction is an annual income of $145,000. That's your maximum, which for most people, that's going to work just great.
Yeah.
It's going to fit in just fine. Interesting thing there, and this makes the Home Advantage program very, very unique. We only have to look at the income of our borrower. So let's say we've got a husband and wife looking to buy together. Combined, they make $200,000. So they don't qualify for the program.
Yeah.
But one of them makes 140,000, the other makes 60,000, and we can qualify under the borrower with $140,000. We just don't have the other spouse on the loan, and they still can qualify for that down payment assistance.
Okay.
Very, very unique. Most down payment assistance programs look at a household income. If you've got mom and dad and a 20-year-old and a 19-year-old home and they're both working, we have to use all of their incomes, and it can be very difficult to qualify them because those income limits are more like $45,000 a year.
Wow.
So very challenging on those to qualify. This Home Advantage program is it's quite robust.
Okay, so this down payment assistance, is it like a second mortgage that they don't have to pay off until when?
Yeah, so we do a standard first mortgage, FHA or conventional, and then we create a second mortgage. And the way we figure out how much that second mortgage is, we take 4% of the first mortgage loan balance. So let's just say we had a $300,000 loan amount, okay? So we're gonna take 4% of that, that's $12,000, all right? So this is a second mortgage, it's gonna be a lien on their property. So they're gonna have the regular first and the second mortgage. Cool thing about the second mortgage is it's 0% interest. So there's no interest that's charged on it. If it starts out at $12,000, that's what it's going to be when they go to pay it off. And they do have to pay it back, but they don't have monthly payments on it. It's just it's going to be a lump sum. Either if they sell the house or they no longer occupy it, they'll have to pay it back. So typically, for most people, they either sell the home or they refinance out of it, and at that time they pay off the mortgage. And it's a simple mechanism at that point. So whatever they're selling the home for, they're going to subtract out the first mortgage and the second mortgage, and they just get paid off right then.
Okay, so quick recap on the DPA is get your online or in-person class, submit the certificate to your lender, and it is a second mortgage but zero interest, and you no monthly, you pay it off when you sell, refinance, or when you move out of the house or not occupy it. Okay.
Right.
And so during the pandemic, what other changes in the mortgage process are there?
Yeah, so the biggest issues we got right now are watching out for people's income that's changed, whether it's reduced hours or they've been furloughed or maybe they've had pay lowered. And we're seeing a lot of changes, potential changes coming even going forward. As an example, where my wife works, they're talking about reducing staff, but they're also talking about, hey, if we don't reduce staff, what if we furlough everyone for 2 weeks at a time? So just these different things that could come up. Well, from our standpoint, when we're verifying employment and calculating our income, we need to be very clear from the employer what our situation is for that employee. If they're being furloughed, or if they're on furlough right now, do they have a guaranteed return date? Do we know what that is? So maybe it delays us, but doesn't stop the whole process. If they're furloughed for 2 weeks, okay, great. We just need to make sure you're back at work and we can verify that again. So we've had this real change in process about how we're verifying employment and getting much more detailed than we used to. If we see someone's income has declined, but now we're seeing it currently back up to where it was before, we need to be very specific and have the employer tell us, due to COVID-19, their hours were reduced or their rate of pay was reduced, whatever it might be. So it's not stopping the process. It's just for us, we have to get a lot more documentation than we used to have to get. And then this is something that most buyers don't know. Right when we're down to funding, okay, we've got everything set. They've signed their final loan documents. We're getting ready to send off that wire. We have to do another verification of employment. We have to do it within 24 hours of closing. So sometimes we can do it late in the afternoon, the day before closing, the morning of closing. And we have to be able to verify that they are still employed. And when we say still employed, not furloughed, they are earning a paycheck.
Yeah.
Had a couple hiccups where someone right last minute, they've gone into a furlough situation when they weren't expecting it. So we've had to be really, really careful about that and make sure we get that documentation together. So that's probably the biggest process change that we've had.
Yeah.
Is asking for more information than we used to. The other process that's come into play a little bit is with clients they're bringing in money to close and either maybe borrowing against a 401k or pulling money out of an investment account, Fidelity or wherever it might be. we've had to verify very clearly, okay, what's that balance now? What's the available funds? The stock market's come back pretty nicely over the last couple of weeks, but boy, 4 weeks ago, it was pretty brutal.
Yeah.
So go into much more detail again, verifying that, okay, these funds are really available and they can pull this money that they've planned to from their account. So those are the big pieces. Otherwise, quite honestly, well, I'll speak for Guild in this case. We haven't had many changes at all. The scores have changed a little bit, but otherwise our guidelines are same as before, and still getting lots and lots and lots of transactions done for buyers. So it's still pretty smooth from that standpoint.
Yeah, that's good to hear. And what I'm also getting from what you're saying is, with all these changes, it's important to educate the clients, the prospective home buyers, that, you know, working with people with, you know, who's focused in communicating every single step of the way, so they set an expectation and they know what's expected from them, what's needed, and also keep everyone on the same page.
Right. Yeah, no surprises.
No, yeah, that's when surprises come up, is when somebody's like, ooh, I didn't know that. So
yeah, that's having that conversation up front, and for buyers to ask that question of their lender as well. We've seen, for the most part, most lenders are working remote right now. At Guild, I would say probably 80% of the staff that works at Guild, not just our office, but across the country, are working from home right now.
Wow.
So that's one really important question for a buyer to ask. How is your company operating right now? And are you guys functioning properly? We were very fortunate at Guild that we had started this process a couple of years ago for a number of reasons, not expecting a pandemic, just realizing that it was going to be, with traffic and other issues, it was going to be easier for people to work from home more often. So we just wanted to be ready for it. Well,
Yeah.
We were very fortunate in that we had prepared for it. So seamless for us, no changes. But I know that can be an issue for some other places. So are they, for example, a question for a buyer to a lender, can you close this loan in 30 days?
Mm-hmm.
Really important thing. If that's what the contract says, that's what we got to hit, right? We got to hit that date. So if your process has been interrupted at all, that you're getting delays in closing. So just something to be aware of, and kind of proactive about, that we're asking those questions and making sure we know the answers.
That's a good point. And so what are the do's and don'ts for prospective home buyers, like the major ones?
Yeah. So the biggest thing of all is, don't buy anything large. Don't buy a car once you're in contract, and check with your lender before you would buy really anything like appliances or any significant purchases. And that may seem onerous, like, what? How can you dictate what I can do? But I'll give you a great example. So it was last fall. Well, it was actually last November. I had clients in contract. We were doing down payment assistance, and they stretched themselves a little bit for this home. So our debt ratio was really tight, and we're using down payment assistance, so they had to have a certain amount of funds for their closing costs. And they called me up the week of Thanksgiving. They said, "Hey, George," we were closing first week of December. They said, "Hey, it's Black Friday. There's some great deal on appliances. Can we go out and buy them?" And I said, "Thank you for asking. Thank you for calling. Please don't," because I didn't want to have any issues with anything on their credit card, anything popping up new on our transaction. One of the things that we do right before closing, and this is an industry requirement, we pull a credit report right before closing. We call it a pre-close credit report. It's a soft pull because we're not getting scores, but we are just updating to find out, are there any new inquiries on their credit report, and have the balances on their accounts changed at all? So that's where we would discover that someone's bought a new car. That's where we discover that all of a sudden their balance has gone up $4,000 because they bought washer, dryer, fridge, stove, the whole thing, all new appliances. So it's really important that that you check with your lender before you do anything like that. Because I've had other clients call me and say, hey, we've got a great deal, can we buy it? Debt ratio is not an issue. Funds to close is not an issue. Yeah, go for it, no problem. But when it's tight, we have to be super, super careful about that. And we have had two clients, as a matter of fact, buy cars on us mid-process. One of them was okay. The other one killed our transaction.
Oh no, yeah.
So that's number one. Don't do any big financial changes. And actually, I would even say don't pay down a bunch of debt.
I was going to ask that too. To the opposite of it, are you allowed to, or not allowed, but is it wise to pay down a large amount of debt?
Typically, I would say no, because if we have let's say someone had a credit card at $10,000 and we pull this pre-closed credit report and now it's $2,000, we have to document the funds used to pay that $8,000 towards that. So typically I would just say, wait. Just wait until we close and then go ahead and pay that credit card. Pay all of them down if you want.
Yeah.
But let's not do it during our transaction.
Don't rock the boat.
Yeah, it creates work on their part. They're going to have to do extra documentation for us for that. So, okay, so that's the really, really big thing. The other thing is try not to change employers. And that can be challenging sometimes because I've had a client have this dream job all of a sudden drop right in their lap. And I say don't change employers, again, without checking with your lender first. Sometimes it's no big deal. Like, okay, yeah, go for it. It's the same exact work. It's just a different company and it's a really cool opportunity. Your pay is going up. Great. Go for it. But other times you're changing to the point where it's a pretty different structure of income.
Mm-hmm.
And that for us, that could cause us to not be able to use all of that income and all of a sudden change where we can't do your loan. So check with your lender before changing jobs as part of the transaction. And then the other thing is, oh yes, kind of back to the credit related item, make sure you keep paying your bills. Because we don't want to have a late payment show up on that pre-closed credit report. And what could be even more significant would be a collection account. If a collection account popped up late in the process, that could cause us issues. So make sure you're still paying all your bills. Job, no big purchases, pay bills. I really think those are kind of the big ones just to be aware of.
Okay.
Do's and don'ts.
If a buyer has that nagging feeling to see if they should or should not, ask your lender first when it comes, if you're in the middle of a transaction.
Yeah. And I thank my clients when they do. So thank you for asking. Go for it. It's totally fine. No, don't.
Yeah. And so last question is, so realtors and lenders, and we have a big team of relationships during a transaction. So with lenders, what do you think is, what do you need from us realtors in order for a transaction to go smoothly?
Good question. The biggest thing for me, one of our processes is every Tuesday we call all the parties in the transaction. So on Tuesday, I call both the buyer's agent and listing agent, and then my assistant calls the buyer themselves. My biggest thing would be pick up the phone.
That's a big one.
Just so that we're in. I may be leaving you a message, and you might say, "Oh man, thanks for the message, but I've got these 3 questions," and now we have trouble getting in touch with each other. So just the biggest thing would be answer the phone, because it's going to be a quick call. It's going to be 2 minutes, but that way we're both communicating back and forth, know exactly what's going on. And then we can also figure out, let's say as an example, let's say there is an issue that pops up in a transaction and I need to get a hold of you, like, Mello, I got an issue here. Here's what's happening. Here's what we're doing to fix this. I need to call the listing agent. Are you okay with me calling and giving them this information? And you might say, not yet. Let's get this figured out first before we do that, or let me make that call, whatever, just so we stay in communication, because ultimately that makes the process a lot smoother for the buyer, that they know agent and lender are on the same page. working through this so we don't have any hiccups. We don't have little things that get crazy. What I've learned over the years is if there is a problem, let everyone know, hey, we got an issue here and here's what we're doing. Because when you tell people early, they have time to prepare for it and adjust accordingly, as opposed to waiting till the very end. Yeah, we had this problem. I thought we could fix it, but we didn't.
Yeah.
So just up front, hey, here's what we're doing to get this handled. So that would be my biggest thing, is just that open communication, answering the phone and talking back and forth. That one thing that frustrates lenders and escrow companies is when we cannot get a hold of an agent to have a conversation about something and stay in communication. So that would be my biggest thing. And otherwise, then letting us know of any changes on your side, particularly with the contract. What can be very tough for a lender is if we get down to the end of the transaction, all of a sudden we find out there was an $1,800 credit negotiated on a transaction for something, and we haven't included our stuff. The appraiser doesn't know it, and we haven't disclosed it. So now we're scrambling to catch up and get that updated with underwriting. So any kind of changes with the contract that's important for us to know.
Yeah, I agree with all that. And I had a transaction that was before the pandemic hit. So we weren't sure about if the appraisals are still going to be going inside the house, and we were still negotiating on the inspection response. And so I was communicating with the lender saying, hey, don't get the appraisal yet because we're still trying to smooth things out. And then he said, okay. And then the next day, the appraiser went into the house. I was like, yeah. So communication is definitely key to a smooth transaction.
Okay.
Oh, wait, no, not yet. Where can we find you?
Oh, sure. Well, the easiest way to get a hold of me is 2 phone numbers. My cell phone number, which is best when it's evenings and weekends, 253-209-1895. And I also love to text. So I find that a lot of clients, it's easier now to text than it is to even call. Text works great there. Number is 253-460-6200. And you can always email me as well. And that's just glane@guildmortgage.net. Sounds
great. And do you have any social media where you have a presence on there and you're active on it?
Well, it's interesting. So I'm not on Facebook. I don't care for Facebook personally. I'm just not on it. But I am on Instagram, and I'm trying to improve my presence on Instagram. So now I'm gonna. This is terrible, Mello. I can't even tell you what my. Just be looking under George Lane, you'll find me.
Okay, I'll put a little static on there too, where to find you.
Yeah.
Thank you again, George.
Okay, Mello. Thanks.